Chris Thornberg, founding principal of Beaconomics. I'm here with a quarterly economic update for the Grazie a Dio Business Review. As you probably know, the last few months have been, well, somewhat turbulent. The stock markets, which had climbed quite tremendously over the course of the last year, have suddenly become very volatile and have lost about 15% of their value from the peak they hit in April of this particular year. With some negative numbers coming out of retail sales and the housing market, overall you're already starting to see the press start to talk about a double dip in the economy. Well, I'm here to tell you that if there will be a double dip, it won't happen this year. Most of the slowing we see in the economy is quite understandable when we look at the broader picture. One of the big characteristics of this particular recession that we've recently recovered from was a big inventory burn-off. That inventory burn-off came to an end at the beginning of this year, and as a result of the stabilization of inventories, we saw a big surge in overall industrial production as a response. But now that inventories are stabilized, of course that surge has gone away and industrial production has taken on, shall we say, simply a slower trajectory of growth rather than slumping yet again. Similarly, the housing markets, while they are also slowing down, this is an understandable response to the removal of the tax credit stimulus program that the Federal Reserve and the federal government had put in earlier this year. And of course, as for the labor markets, those numbers there overall continue to remain positive. Yes, we have not seen the kind of job growth overall that we would like to see, but part of that has to do with the vacuum created by the massive surge in census hiring over the course of the summer. If you look at other statistics such as weekly hours being worked and incomes, it's clear the labor markets are still in recovery mode. So does this mean we're out of the woods? Unfortunately, no, we are not. While the economy is likely to continue to grow for the rest of this year, we still have significant worries about 2011 and beyond. The government stimulus programs that have been put into place have certainly helped stabilize the economy, but those government stimulus plans have also created their own potential problems. There's still a massive amount of liquidity sloshing around the U.S. economy, liquidity that will eventually have the ability to create inflation in the U.S. economy. That means the Federal Reserve will eventually have to start tightening and interest rates will rise. Similarly, Americans feel like they are saving more, not because they are spending less, but because the government has put into place significant tax cuts that have significantly expanded the already large federal deficit. Right now, the federal government is borrowing close to $1 trillion a year to make up the gap between its expenditures and its revenues. In 2011, taxes are going to have to rise, and that's going to have a significant influence on consumer spending. We worry about how dramatic these effects will be on the U.S. economy, and yes, they do have the potential to create a double dip in our economy. But in the short run, the recovery will continue. The rest of this year we'll continue to see 2 to 3% growth rates. So enjoy that, but be cautious about 2011 and beyond. For more information about the economy, GDP growth, our forecast, inflation, and a bunch of local statistics for the state of California, please visit beaconecon.com. Until next quarter, this is Chris Thornberg signing off for the Grazie a Dio Business Review.